And now we get to the last major key reference area, which is the launching points of directional conviction. So let's just jump right into the charts to take a look at what this means. Okay, we're back to a chart of the E-mini S&P 500 futures 5-minute chart. And previously we were talking about high volume nodes, i.e. horizontal volume. Well, now with this key reference area, we're talking about directional conviction, which is often synonymous with vertical volume. Like we had said before, take a look at this bar that started here, right? This big directional move, and its related vertical volume bar right here. When this bar started, this is where the expansion happened, right? This is where the market just took off really fast, and in 5 minutes it went from here all the way to here, almost the range of the whole day in 5 minutes. So it was a lot of strong directional conviction all at the same time, right? Now, if you remember, this was the same example where this thing hit a previous key reference area above here, which was a major tail from before. But anyway, so that's why when it hit here, it got snapped back quickly and it ended up going back down. It got rejected. But if you'll notice what happened when it got rejected, kept going down, and it came back to test the launching point of the directional conviction, the point at which directional conviction really started and took off. Now you could say it was here, but this is where it really just started expanding and the real volume came in, right? And so we see that when the market came back to test that, this is where it found a stopping point. It found support near the area where directional conviction started and took off. And what happened? It bounced and it kept going higher from there. Now again, something to keep in mind with key reference areas. They often act as support or resistance, but just as importantly, they give us information about the markets. They allow us to read the markets. And this is key. Most traders are out there just looking at chart patterns or looking at indicators and trying to predict the markets through them without really understanding what's going on, without the ability to read the markets. Reading the markets means being able to look at the chart and deciphering what was likely happening from the different types of participants. Who was in control? Was it the buyers? Was it the sellers? Who's likely to remain in control going forward? What's happening with value? What's happening with price acceptance or rejection? What are the key trends? What's the context? This is all reading the market. And this is what professional traders do. They understand it at a deeper level and they read what's happening. And the way you get to read the markets really well is through key reference points. Because again, key reference points act like a line in the sand. When you're on one side of them, it means something. And when you go through to the other side, it means something else. So for the instance of directional conviction here of the launching point, when things launched higher here, it was saying, right, if you read the market there, it was saying that the perception of value had changed somewhere. We had previously been in a balance area before, sideways, and now we were taking off higher strongly. So something had changed. That's instantly what it tells you. And it tells you that the good likelihood is that higher prices are coming because of this major directional conviction starting here. Now when it came back down to test this area, what was it telling you? Well, if it had broken right through it, if it had come here, tested, and just broken right through it, what does that tell you? Think about it. That would tell you that this directional conviction, right, was a fake out. This was something that started, but sellers had rejected it, said no, we believe value is lower. We don't believe that it should be higher. And it would tell you that the sellers were the more aggressive group, the ones in control, and that likely prices are going to be lower. Either we continue the balance area from before or we move through to the other side, to the downside. That's what it would tell you. But the fact that it held tells you, yeah, buyers are still in control. The place where they launched this move higher was now defended. They bought more again here. They still believe in their view. And others who had missed this up move, now seeing it come back here to test it, get back in on it, and we end up moving higher. So this reaction up tells you that the greater likelihood is that the buyers are still in control. Again, it's all about likelihood. It's never going to be exact, and it's never going to be certain. There are no certainties. There's always just thinking in scenarios and in probabilities, right? What's likely to happen? What's the common thing that usually happens? And the common thing you get from what? You get from the certain laws we talked about, and after a while you get it from experience. You see what usually happens, right? And you look for the times when the common does not happen. That gives you great information. But also you just watch to see what happens at the key reference areas. How does the market react, and what is the speed and conviction in which it reacts? For instance, if the market came down here, right, to test this area and just kind of just sat there lazily going sideways, not really doing one thing or the other, it's very different than if the market comes down and just bounces sharply. When it bounces sharply, it tells you, look, the buyers are still in this area. They're still interested in taking the market higher. They're defending this area. So that gives you good information. And if it comes down here and just plummets right through downside, that tells you, look, the sellers that were active up here, they're still active down here. They've followed this thing down, and lower prices are very likely. Now, in this instance, right, we got this directional conviction, and then we got to test all the way of it very quickly, within what, 10, 15 minutes. This isn't usually what typically happens. The only reason this happened in this instance was because there was a major key reference area here from the previous selling tail that we looked at when we were looking at selling tails and buying tails. And that's why it basically reacted so quickly to retest this area. Usually what will happen is when you get a breakout like this and you get this directional conviction, the price won't pull back this deeply. The pullback will be more shallow and we'll only get retests of this area down the line, maybe a day or two or sometimes a week or more later. It's usually not so quick. So let's take an example of where it happened a while later and see what happens there. Okay, here's an interesting example. What you'll see in this chart is this massive area of directional conviction starting here. This 5-minute bar just skyrocketed higher on really large volume. And it ended up being a legitimate move because the market just kept following through higher and higher and higher. Okay? And in the afternoon, it kind of gave up a decent amount of it. And this is a normal, price thrust, swing high, correction. So this is normal for it to come back down a bit. But what happened? The next day, we gapped down. Okay? And we gapped down near where this directional conviction started. But what happened? Well, we gapped down, we kind of just start going sideways, sideways, sideways. Right? We don't quick gap down, quickly reject this area and fly higher. Now, if this was a legitimate move that is going to have any real lasting power days on end, what should have happened at this key reference area is this thing should have just came here and just bounced sharply higher and we go up, right? But that didn't happen. It came here and just kind of goes sideways and then it breaks through it here, okay? It goes sharply through it. But then when it goes through it, it also kind of just starts going sideways. And we do end up getting the bounce eventually. Now what does this mean? There's a few key concepts here. The first thing that this means is that when you go through a reference area, and in this case we're talking about this directional conviction launch point reference area, but when you go through it, you also have to read the market, right? So this thing went through it. Typically, what happens when you go through a key reference area is that you should accelerate the other way and just keep going, because all the buyers here, right, have now been proven wrong. They're stuck in their position. They'll be forced to sell. And it would say that there was a major change in the perception of value in the market and who's in control. But again, even when we broke through it, it kind of just went sideways. So this was telling you, okay, on this particular day, there's not going to be much conviction one way or the other. This was telling you that this is probably going to be a range-bound balancing type of day, which ended up happening. It didn't do anything, right? And that's information in and of itself. When you're at a key reference area and you just can't do anything one way or the other, that tells you there's not going to be any directional conviction anyway. That's number one. Number two to take note of is don't think that anytime you break through a key reference area, for instance here in this down bar we were below it, right? That instantly means that that's it, we've completely rejected it, now we're going the other way. To completely reject a reference area, you have to show directional conviction the other way and accelerate through it, right? And you at least have to spend time below it in this case, and time equals value. You have to establish value at a lower point, whereas here it didn't spend that much time. It was a few 5-minute bursts and then once it went back up. So that was telling you there's pretty much ambiguity in the market, there's no directional conviction, and we were probably just going to go sideways. Okay, so again, the key point here is anytime you break a key reference area, it doesn't matter if it's to the downside or to the upside, for it to be really something legitimate and something that tells you major moves are coming the other way, price has to really accelerate through that and then spend time beyond that. If it just does this sideways stuff, it's just telling you there's no directional conviction either way. But let's see what happened after this. Let's fast forward a bit. Okay, so as you see, when we came down, we just kind of went sideways and the bounce wasn't that great, right? And then we came down again the next day now, and then again, right? At all these points, it just kept testing this key area, right? Tested it here, it's testing it here. Now things start getting interesting. When a certain key reference area keeps getting tested time and time again, now things get interesting because it's basically going to do one of two things. One, the key reference area as a whole is going to hold and we're just going to bounce here higher, or something's really going to break down and take off to the downside. And again, we're speaking in the majority of cases. Well, what ended up happening here was the market tanked through this. Now it did spend time below it, as you'll see, and then the next day it just gapped down and just kept getting killed lower. All right, the fact that this key reference area hadn't held and we had broken through it and accelerated and spent time below it gave us an indication that there's a good likelihood that we were going to be moving the other way, that the sellers were now in control. So you see, it's all about reading the market at key reference areas and making judgments as to what's happening and what's likely to happen. Again, never in certainties, always in scenarios and probabilities. You will get in trouble if you start taking these things as absolutes. They're never absolutes. You're always thinking in scenarios. If this happens, this means this. If that happens, this means that. That's how you're thinking. And sometimes stuff is going to happen that's just confusing, that you're not going to know what's happening. You know, sometimes that's the complexity of the market. If it were that straightforward and simple, you know, everyone would know how to do it and then there'd be no edge. You could never make money because it would be too easy. So be thankful that it's not that simple. Be thankful of these complexities, because if you learn how to read them, unlike most traders, you're really going to have an edge. So this is a great thing. Be thankful for the complexities. Okay, a couple more things to discuss here. I've zoomed into a different area of this chart to show another concept, and that's the fact that gaps, like we had said, gaps are when the market closes a certain day at a point and then opens the next day at the next market open at a point that's much further away from that. And so it creates this gap. There's no prices here, there's nothing happening, and that's why it's called a gap. It looks like a gap. Now often, if the gap is big enough, the gap itself signifies directional conviction. Why? Well, because if the market closed the previous day here and then is opening so far below it, that means a lot of directional movement happened overnight, during the overnight what's called the Globex session, which probably means that there was some major news in Europe or Asia or something, directional conviction happening there, which affected the US markets overnight, and the US markets opened way lower the next day. So for them to open this low during the night session, they must have really taken off down. So for these big gaps, these also signify launch points of directional conviction. You can't see the volume because there's a gap, there's no prices here. But if you were to look at a chart that showed you the overnight action, which you can do, you would see directional movement. Now you may not see the vertical volume associated with it because in the overnight session, volume as a whole is very low. Very few traders and institutions trade the overnight session as compared to the what's called the day session here, where the actual pits are open in Chicago, for instance. You know, where you see the traders screaming on the floor and all that, or the New York Stock Exchange, or any of that's the open of the market, and that's what's called the day session. Anyhow, just note that when you see these large gaps, that they note directional conviction that had some real steam behind it and that followed through. Right now, here, for instance, was a small gap, not that big of a deal. But when it's like this size, you know something is up. So what happens when we retest this area of directional conviction? Well, where do we retest it? So we go 1 day, 2 days, 3 days, right? And the fact that we spent 3 days lower after this gap down meant that this directional conviction was legitimate, right? Price not only went down, but it formed value below. So price was accepted lower, right? It wasn't quickly rejected. So the sellers that drove this down remained in control, and then they found balance with the buyers down here. Well, the next day something happened to cause the market to go back up. The buyers came in. But look what happened when they reached this area, this key reference area of where the directional conviction had launched through the gap. What happened is they hit it and they reacted down. They moved sideways a bit and then they got rejected down. They moved down close to 10 points off of this directional conviction. So again, it acted as resistance. All right. And then moving a little further along, what did you see happen? So this day, it got rejected, but if you'll notice, the rejection wasn't this, hit it and bam, quickly take off down. It went sideways, rejected down, then kind of went back to retest it. So this was telling us, okay, momentarily, this key reference area is holding, but it's not causing a major quick rejection in prices, which means that there's more of a balance between buyers and sellers. Sellers are not that much of the dominant group here anymore. It's just causing a sideways movement. And then sure enough, the next day we go right through it. And now what do we do? Right when we go through it, we just keep going straight up. And like I said before, that's the key thing, which showed, right, that when we went through this key reference area and accelerated to the upside, that now buyers were indeed in control. And look, it ended up going quite a bit higher after that. And one last thing I want you to take note of is the fact that sometimes when these launching points of directional conviction happen, quite often we're not even going to go anywhere near revisiting them anytime soon. Okay, because if they're a really legitimate move and one side is in control, in this case the sellers, here it really started taking off down right at this point, straight on down on high volume. Okay, if it's really legitimate and it's the start of a new trend, it's just going to keep going lower without even coming back to revisit it. And that says something in and of itself. If it doesn't try to go back, that means the directional movement is really legitimate. But what will often happen is it'll go back to test a different kind of reference area. That'll give you some information there. For instance, here we were balancing before, we were going sideways, and this was the bottom of the balance area. We had, a few major lows here and here and here, right? So look what happens. Let me zoom in a bit closer here. Okay, here I am a bit closer. So the directional conviction really started from here, drop down, goes below the bottom of this balance area, okay, and accelerates through, which is a good sign that prices are going to go lower. But what does it do here? It does a mini bounce, okay? It bounced about 5 points. And as it went up, what did it retest? It retested the bottom of this balance area, the bottom of this breakout point. Right? Now, like we had talked about before in key reference area 2, which is the range extremes, right? This itself was a key reference area. This was the extreme of the balance area, the bottom side where the lows were taking place, right? So on the first time down, after this launching point, it went right through it. That was information in and of itself, that this key reference area did not hold. Sellers are really in control, right? But the next test of the key reference area comes back the other way. So we break through it, right? And now we retest it here. Now often what will happen, and this is a key thing to keep note of, this is a key principle too, is that support often becomes resistance after broken, and resistance will become support after broken. Now what does this mean? This was a key reference area, the bottom of the balance area, and it should have acted as support because here, it came here, it bounced here again, it bounced here again, so it was acting as a support area. Well, now we broke through it. Once we break through it, think about what's happening to the other market participants. Think about the buyers here and here and here. Once we just broke through it, these buyers that had bought here and here and here, if they were still in their position, now their position is underwater. Now they're losing money. Right? So what will often happen is once we retest this area, as like we bounce, so we go close back to it, these people will sell to get out at break even. And when they sell, right, it'll cause this reaction and then we'll go back down. So we bounce up, we hit this previously broken support area. Now because of their selling, it becomes what? Resistance. Okay? So that's one thing to take note of, especially in these instances when you pair up these two reference areas together. What will often happen is these major directional conviction moves will take you through a balance area extreme, will break out one way or the other. This time it was a downside breakout through this balance area, right? Now we're not talking about strategy or tactics here, but if you wanted to get into this market on the downside, seeing the directional conviction and seeing it break through this key reference area told you that there's a good likelihood it's not going to go anywhere near testing this again. That was information in and of itself, right? Because it broke through a major key reference area here. So your only chance to get in would be at a retest of this previously broken balance area. And understanding that support, once broken, often becomes resistance, this would have been a good place to short, and it would have provided a good short opportunity. So that's just another key concept to keep in mind regarding key reference areas. And it'll help you in understanding the markets and later also in trading them well. And overall, it just shows you the wealth of information that can be gleaned from key reference areas in general. It shows you how much you can read from them, how much they tell you about who's in control of the market, and how they act as support and resistance to give you a heads up of how the market may react ahead of time. So I suggest strongly that these videos about key reference areas that discuss the 4 key reference areas, you watch several times, you take notes, you understand each scenario, right? You remember all the things I said about them because these will serve as a crucial foundation for understanding a lot of things about the market.